Hello, good morning, everyone, and good afternoon for the participants who are participating from different time zone. Welcome in Dhruv webinar covering the new proposed law in KSA. Firstly, let me introduce myself and Mahmoud. My name is Hani Nagar. I'm Associate Tax Partner, Managing Middle East and GCC in Dhruv Advisor. And I have here also on the screen and will join us also for webinar. Mahmoud, he's our tax manager, corporate tax for GCC.
Yeah.
So we can start. Thank you, Mahmoud. So we can start as most of us or already all of us hear some news in past days already released even on some of media and press release that KSA or Saudi, they are now introducing a new income tax law and also introducing a new tax and zakah procedures law. It's already released or published for public consultation. The target to complete the public consultation will be in December this year. So most probably, if already everything went smoothly, they maybe release this new law by January, so it can cover or start to be implemented starting from next financial year, which started in Jan 2024. But it's not confirmed yet. This is our expectation. However, we need to wait and see what will be the final date of implementation of such new law. So we can go, Mahmoud, please, next time. So we have for two main law or that I can mention that the proposed law, we have income tax law and another one for tax procedures law. So we'll cover first the income tax law or the proposed income tax law. The proposed income tax law, it comes in four provision. No, please, Mahmoud, go up. In four provision. So five parts. The part number one as a general provision, and part two, taxation of legal person, part three, tax on income for non-Saudi natural person, and part four, tax or withholding tax, and part five, other provision. And under part two, for taxation of legal person, we have main five chapters: the taxable legal person and taxable income and tax base and special provision and calculation of due tax. Due to time of the webinar, of course, if we need to cover all the provision on the proposed income tax law, it will take also, for each provision can take a separate webinar or workshop to discuss, but we will highlight or we'll try to cover the main important nine aspects or 9 points that's covered by the new proposed law, which number one, for residency, and then for person subject to tax, source of income, BMAN establishment, related party, exempt income, interest deduction, transfer pricing, and participation exemption. Mahmoud, I think for the proposed income tax law, they came with some new additional new changes comparing with the current income tax law in KSA, especially when it comes to residency definition and person subject to tax and source of income. So
Yeah.
may I request please to give also or to share your or some insights on this one, please?
Okay. So the new draft law, when comparing to the current law, especially when it comes to the natural person, they have extended the requirement and the conditions where the natural person becomes resident in KSA. For the current income tax law, it requires that he resides for a period not less than 183 days or has a permanent place of residency which he resides not less than 30 days. But when it comes to the draft law, now we have conditions related to expats when they they asking for if the person holds a statutory residency permit and existing in for 30 days in a period of 1 year, it becomes residence in KSA. And also when you can see if the person has resides in KSA for 90 days in a span of 270 days, it also becomes residence in KSA. And this can put some pressure on the expats and people who comes into KSA when they doing active business. Like now the period they need to look at is much lesser period than the period explaining in the current income tax law. And the conditions here need to be explained in the executive regulations, because now we have two conditions like contradicting, which is other, like if the person holds residency for 30 days and it become in the span of 365 days, or 90 days in a span of 270 days. So this is need to be explained when each case is going to apply, especially when we're talking about natural persons. And that's also make the GCC residents who comes into KSA and doing business, does they need to look after this condition? Yeah, definitely, because they will definitely be affected by the new regulation. Also, this can also affect how now we can win non-residents in KSA dealing business in KSA, and these new conditions for residency can create cases where dual residency according to the double taxation treaties with KSA exists. So mainly the double taxation treaties, when they get to residency, they say and put conditions that make the taxpayer is resident in one or two countries, but mainly they refer first to the tax residency conditions that are in the current local laws. And due to the new draft income tax law, this can create dual residency, and which will put also some pressure on the taxpayer when he is dealing, especially the non-residents in KSA, when they are dealing with income coming from KSA to outside KSA to the country of residency. Many cases, in my thinking, they're going to be dual residency cases due to this new proposed income tax law. Also, now if you can see, when related to persons subject to tax, there is some quite few interesting changes that happened. Now it's more diverse, more specified, and it is actually more than these items. The law stated a lot of conditions, but we have chosen the most interesting one that we can now compare between. So right now, the law when it talks about who's person subject to tax, they changed the word from business to activity. And here's activity versus business, as we say. In the definitions of the new draft law, activities here means that the one should, or the tax person should practice activity for habitually practice the activity in the kingdom in order to consider this as an activity in the KSA. In the current law, this specification and this details are not existing, and it gives some relief to taxpayer. Now we need to know if the activity is done on one-time basis. Does it considered activity in KSA? In the draft law, no. One-time transaction is actually stated that the activity definition should be on a habitual basis, and should be practiced for the purpose of producing income as an active business. Also, the definitions here in the current tax law the partnership was different, was like, what you call it, it's a transparent entity, and the law was dealing with the stakeholders, with the owners of the partnership for dealing with the taxes. But in the draft income tax law, partnership is now a legal entity, and it's different from its shareholders, let's say, from its owners, and the tax is due on the partnership itself, not on the owner. And now it's become an entity rather than a transparent entity that the tax law didn't consider for taxation. But in the new law, in the new proposed law, now it's and this is one of the biggest changes, because partnership in KSA now have to deal with the concept that now the partnership is responsible, the company itself is responsible for taxation rather than its owners. And there is one interesting change that we have seen right now. It's now stated that opening a bank account for natural person residents in KSA, now it's considered an activity of a business activity. And this is one interesting, like, if you're opening a bank account in one country and I'm not doing business in that, how this is considered an activity. But in the next slides, we can now see that this provision has some impact on the taxation and the income subject to tax. Sources of income, and this is one of the also huge changes here, not for specifying each item of income, but also for the presentation. Like, if you can see in the current income tax law, two general paragraphs that gather, it's open for a lot of interpretation what comes under the source of income from KSA, because it includes all revenue, all gains, and all profits, and did not specify each items. But in the draft law, it actually specified, and a lot of items have been also introduced. And there is confusion in the current tax law. At some points should be considered income from source in KSA or not, but the draft law have cleared that, especially when it comes from dividends from a resident or a legal person. This is also considered a source of income from KSA. Capital gains, also from disposal of residents' company in KSA, is also a source of income. And if you can see, one of the interesting change here, that they are now considered service performed. They have now considered service performed wholly or partially, even if it was performed remotely, as an income from source in KSA. And this is one of the interesting concept, because the law considered the service itself, the rendering of the service itself, rather than the payment for service. And if you can compare this draft law to the other laws in the region, you can see when it comes to source of income, they can see they refer to the payment that comes from the country to the other, not refer to the service itself. And this is a new wording here that's very wide and can include everything, because if you're rendering service to KSA company and you're outside, and this income, this service have been rendered, and as a work have done outside KSA, the employees, the people working on the service are all outside KSA. But the beneficial here is the KSA company. This is considered a source of income, even if another company is going to pay, even if it's a group service that is going to be paid by the headquarters in other way. As long as the beneficiary is a KSA company, this is considered the source of income in KSA. And this also can affect those holding taxes. When we're going to withholding taxes, and we're going to see this later in this webinar, this is going to affect how withholding taxes is going to be done in KSA. if now all service rendered, even if it was rendered remotely, it will be considered a source of income here in KSA. Also, there is one line condition for headquarter services. It's now headquarter distribution of services considered service in realized in KSA. However, as we're going to see those holding taxes, right, the current income tax law was stating clearly a percentage for the headquarter service, but right now it is it is not separated. It's stating services all over, and that's why they had to mention that headquarter distribution of services considered the service happened in KSA, because when the law is going to talk about withholding taxes, they are not going to mention headquarter distributions anymore. It's all services. Hani, I believe the law now has also introduced interesting points in when it comes to related to permanent establishment. And can you tell us more about that?
Yeah, sure. Thank you, Mahmoud. So, permanent establishment in KSA, it's a very interesting topic and discussion. Let me take you a little bit way back, some years back in KSA when the BE or permanent establishment concept introduced. ZATCA, they released a circular. Maybe already we all heard about it. It's called virtual BE, meaning if the service rendered not physically even in KSA, it can trigger BE risk in KSA. And because of this circular and practice also in KSA, there is a lot of issues happening between taxpayer and ZATCA about the definition of permanent establishment or the concept of permanent establishment, and shouldn't be physically present or not physically present if the contract signed inside KSA on behalf of the entity outside KSA or through agent. So all of these issues start to arise on the when it comes to practice implementation. And then recently, ZATCA released a guidelines on permanent establishment, and they highlighted they tried to fix some of these issues by highlighting, again, it's not necessarily, it's a must to be physically present to create a service BE in KSA. So if a taxpayer or an entity in UAE, they are performing a service in KSA, previously it can trigger a BE, but by this circular or so by this guideline which recently released, they said no, it should be physically present in KSA. And again, BE, it's a very I will not say complicated, but very risky topic, and taxpayers should be very careful about it when they plan any tax activity in KSA. Coming to the proposed income tax law now. Interestingly, they are highlighting now some of additions on the concept of BE. As an example, they are saying now for BE, for non-resident, of course, it would be considered a BE if there is a building site or a construction or assembly or installation project or supervisory activity, okay? In addition, also, if a non-resident person will be considered as a BE if the service of performing the service by himself or through employee or affiliated or contractors. So this is very, very interesting. So now, if you are performing any activity, any service in KSA through some employee or you already contracting a contractor inside KSA, but you are not resident in KSA, it can trigger a BE now for you in KSA. But however, they limited the period now for this criteria to be at least 30 days within 12 months period. So they reduced even the physical presence or this criteria to be 30 days only. So we believe in if the law come like as they are proposing, it will be a huge tax impact for non-resident to evaluate or to reassess their position in KSA. And we believe also why KSA, they are introducing such dramatic changes in BE, because they wanted to bring the economics or the activity to perform inside KSA to encourage people or encourage the taxpayer to have an entity rather than have a BE. So I'll give you an example. So if if someone decide to go on a contract in KSA with any customers there. So when he assess the tax position or tax risk, he can find now on the proposed law many criteria, many tax risk can be arise. So he can simply decide, okay, instead of going for such risk, I will mitigate this risk by having a LLC or open a branch in KSA. So from KSA economic perspective, it's much better to them because now they have a full control on the activity. You need to register as a taxpayer, file a tax return, paying taxes or zakah, whatever. So it will be for them as a governmental authority like that can more beneficial. And from your side as a taxpayer as well, you can mitigate or avoid all of this risk for BE. If we go even for the proposed income tax law, we can find also some additions for BE. For as if you deal as an independent agent. So if you are a dependent agent or you have contract on the name of non-resident, if you have the contract of service rendered by the non-resident, if you have a contract or transfer ownership of goods or properties, all of this aspect, all this criteria, again, will trigger a BE. So comparing with the current income tax law, it's a very small definition of BE. If we take it along with other circular issued by ZATCA, along with guidelines issued by ZATCA, we believe the draft income tax law, which is under discussion now or for public consultation, it will be a bigger umbrella, and it will create another way of thinking or evaluating or assess the position for entering the Saudi market by signing contract or dealing with either a customer or supplier even. So if we look in general, in summary, we need to assess as a taxpayer, we need to assess the service will be rendered, the time will be spent, who I'm dealing with, who will be signing the contract, who will be signing the contract of half of me. Will we have any building, any office, any place of management, any decision will be taken? All of this question, you need to list it down as questions, and you start to tick the boxes in front of each question. Is it yes or no? Yes or no? Yes or no? If you found them, or for the majority will be yes, then you need to think about, instead of having a BE, then you can have LLC or a company. Okay, Mahmoud.
Okay.
In relation on the same, we can move also for the next slide. Now, also in relation to the same, so about away from BE, the current income tax law, if we compare with the draft income tax law in relation of the related parties definition, so we can find that in the current, the proposed income tax law, they make it more simple, more shortened, into the point. However, it become wider. So if we look on as an example, they are saying that for related party, 2 or more natural persons are related party person if they are relatively through marriage or otherwise relative to fourth degree. So you have fourth degree, father, grandfather, grandfather. If you have a marriage like your wife, husband. So they now going for the fourth degree, or partner directly or indirectly as a partnership. Even for effective control, it will be considered as a related party. Effective control meaning what? Can be concluding of any agreement to provide management service. Trustee or manager of trusts have control more or over than 50% or more of board of director. Has the right of 50% or more for income or dividends over 50% again of the taxable income depends on the transaction, of course, for such a party. So now the control criteria, it will be rather than ownership criteria. Okay, if you look, we can find forced decree, husband, wife, sons, marriage, 50% of dividend, 50% of ownership, 50% of decision, 50% of controls. So investor now also to need to be careful or should be take care of review all the related party based on these criteria. Instead of, because if you be covered under the related party umbrella or criteria, then you will be subject automatically to transfer pricing rules or guidelines in KSA. So it doesn't mean that you need to change your whole business because of this, but at least to be aware, I will be subject to such a criteria, and what should I do from now, and how I plan it from now to minimize as much as I can from tax impact on my business in KSA. Yes, Mahmoud, please. Also, one of the interesting point also we saw on the draft or the proposed income tax law, they are now covering some other aspect like exempt income, like participation exemption, which I believe, Mahmoud, also you have some views on this topic.
Yeah. So going on for the exempt income here, before moving to the next slide, here the exemptions now is very specified. Like the new draft law is specifying, and it's very comprehensive rather than the current law. The current law could generally use general wordings, but the draft law is now interconnected, is connected and related to each other. Each part is connected to the other part, especially when it deals with how to specify the exempt income, the income subject to tax, the tax persons. And they are now introducing a new concept here, is participation exemption, which we'll review in the next slides. And also there is an interesting point here. When related to exempt income, they stated that if a KSA company gets income from a company or from a country which have a double tax treaty between KSA, now this income should automatically be exempted directly in the tax return, which is interesting. They are now using the exemption method rather than the tax credit method. And we are willing to see if how that is going to make the procedures for applying this. Does we need to get approval of ZATCA on the income that we have received from other country, which we have a double taxation treaty with it, before we exempt this automatically? Or does we need how ZATCA is going to approach this, and does the company going to apply this automatically, and then when ZATCA comes, the tax audit is going to see the requirements and the documentation required for this? Needs to be clarified, because they are now using the exemption methods, and which is in the luck of the companies working in KSA. But how ZATCA is going to approach this will definitely affect how the taxpayer is going to how to deal with income from other country, which is interesting. Okay, moving on to interest deduction, which is also here we can see in the interest deduction, the current income tax law, when dealing with interest, they made a formula, and I'm not going into details of how each formula is calculated, but I'm going to give you a sense of what is the difference between two. Right now, the current tax law, the formula depends on the both the tax deductibility for interest depends on the interest income plus the expenses allowed. So they use two criteria, and it's definitely related to interest income, especially because and they are adding 50%, but as I say, they are related to interest income and interest expense. When it comes to the draft income tax law, they actually followed some of the new trends in the regions, and they now connecting the interest deductibility to the taxable profit before interest, and it's 30% from the taxable profit. And this one interesting change also will definitely affect the taxpayers and investors in KSA when they are restructuring their funds and their capital structure, and they how to going to apply the new interest deductibility rules. But also under the new proposed law, this formula will not allow interest to change the taxable income from taxable income to taxable loss. Before this can happen, because the formula there allows this, because it's not connected to a percentage of the taxable income. And there are interesting cases where there is no taxable income, it's taxable loss. And under this condition, when there are tax losses before interest, there is no interest is going to be allowed as deduction. So your interest will not be added to your tax losses. So in both cases, interest will not transform taxable income into tax loss. And if it's a tax loss already, they are not going to allow deduction for interest. And these interest expense are with no tax benefit to the company, which again, the companies and investors in KSA needs to review their loan structure, review their plans and budgets for the upcoming periods, and see how much interest expense now they are paying, and make a prediction for the upcoming tax returns under this new law, and see how much of the interest expense they are not going to benefit from in the next period. So I believe, Hani, can you talk us about the transfer pricing?
Thank you, Mahmoud. So coming back to also one of the interesting point or topic on the proposed income tax law. Now they are also for transfer pricing. They listed or highlighted some other or some additional aspects, like controlled transaction, as an example. So controlled transaction, it must be similar or to those comparable transaction between independent parties. So if it's considered, is in a summary, the proposed law saying that for if it's considered as a favorable transaction, if it will be considered as a favorable transaction if doesn't include material difference as per relevant pricing mechanism, or if there is our differences shall be amended on arm's length basis. Maybe you're already aware or hear that there is some transfer pricing changes happened in KSA and recently also in the bylaw or the guidelines, and they introducing also the transfer pricing on Zakah payer as well, not for taxpayer only, with some threshold to be reached for each financial year or tax year. And also introduced also advanced pricing agreement, which was not before in the old tax law in KSA. So if you wanted to go into any agreement, you can approach ZATCA to have an advanced price agreement, or which ABE, and you for any transaction which can fall under the transfer pricing or with the related party especially, and get an advanced pricing agreement with from ZATCA saying they are approved such a transaction or mechanism or the pricing agreed with the related party for such a contract. So you can avoid any challenge from ZATCA later when it comes to transfer pricing audit from their side. And you can work on the transaction base, you can work on the contract base, you can work also on the volume base, whatever your case, you can approach ZATCA on this regard. So this was not before, it's newly introduced on the changes in transfer pricing guidelines, and now they are bringing again on the proposed income tax law. Yes, Mahmoud.
Okay. Participation exemption.
Yeah, so now also we can see also for the proposed law, they are introducing the participation exemption. So participation exemption, it can be, mainly it will be covered on dividend or capital gain or liquidation. So if you have a 10% ownership for 365 days at least for any other entity or a company, and you are getting dividends or there is a capital gain, then it will be exempted from income tax in KSA. There is some exception given that participation exempted in relevant jurisdiction, participation is a resident in a preferred tax regime, distributed income can be deducted for tax calculation. So if you are a tax resident in, like we are using in tax field, the tax haven country, maybe it will be not be you not be granted such exemption and based on the new law. So again, the taxpayer now need to, based on this new law, if it's officially released, or he can prepare himself from now also as well. If he already have a percentage more, 10% or more or lower, so he can evaluate now cost and benefit. If I have 10% and more, well, how much exemption I can get now in case if I receiving dividends or there is a capital gain. So this need to be reassessed again on the line of the new proposed law. Please, Mahmoud.
Withholding taxes.
Yeah. So withholding tax, we again in KSA 2 months back or 1 month of even 2 months back, they changed the withholding tax rate. And the most important one, which you noticed in the previous officially changes happened, they removed the withholding tax on the payment to related parties, which was 15% before. And this was one of the major issues on practice, on ground in KSA when it comes to any payment to related party. So taxpayer was suffering 15% related parties, even it for some cost charges or whatever. And in practice also, even the related party is based in UAE as an example, and he already have some service rendered from third party as a supplier, and he charges the same cost to his related party in KSA. In KSA, in practice, they are applying 15% on such a service. However, in some cases in KSA, that withholding tax become 5%, not 15, because of such recharges was based on cost basis without any markup from the related party in UAE, and it come from other third party. I'm only on the middle to recharge same cost to other entity in KSA. But again, it was not clear in the law on the guidelines in KSA, and that's why there is many cases go to appeal or went to appeal, and some of cases already won, some of cases already lost based on the transaction or volume. Now coming to the new proposed law in KSA, we can, if we compare with the current income tax law, we can find they reduced some of the percentage and increase some of the percentage. As an example, for management fees, which is 20%, they will reduce it to become 10%. Despite there is some discussion happened before that the proposed law will come waiving or removing the management fees from the table. But we can see that brought it again, but with 10%, not as a 0%. Reality, it will be the same: dividends, rent, return on loans, insurance. However, for technical and consultancy service, it was 5% before. Now, in the draft income tax law, it will become to 10%. Other service will become 10%. Transaction with preferred tax regime, this is the one new addition, which is 20%. There is no clarity. Maybe it will come on the executive regulation or by law. What they are meaning about preferred tax regime? Is it a country with no tax regime or a country with reduced tax rate? So there is no clarity so far. But however, they are introducing now 20% with preferred tax regime, which we believe you should from now as a taxpayer to build or plan your payment to other countries if you feel it can be considered as a preferred tax regime. Of course, this is if there is a tax treaty between KSA and other countries that you are performing or receiving this payment, of course you have the right to follow or apply the treaty clauses or benefits based on three options. Either you approach ZATCA to get an advance ruling, or you can deduct the withholding tax and approach ZATCA to refund the difference between the rate applied and the rate on the tax treaty, or you can have or you can take the position or to apply the treaty benefit from day one, and you will have also supporting document when ZATCA requests to provide. But on the third one, from our experience in the market, it's not an advisable position, because ZATCA always challenge this one and keep trying to find any gaps or any rule to insist to collect the withholding tax. And you can imagine, in addition to the penalties, which increased now on the draft tax procedures law, which Mahmoud also will cover quickly. So in summary, withholding tax, again, one of the big additions or big changes on the current or the proposed income tax law. Thank you, Mahmoud, please.
Okay. Can I just put some inputs here on the withholding taxes, because there are some new additions to the wordings and to the law in the upcoming income tax law. There is one interesting, that is capital gain is treated as dividend distribution. Capital increase capital increase is now treated as dividend distribution. And I believe they mean by capital increase here is increasing capital from retained earnings. So this clause, I believe they added it because the practices of some shareholders, they now using this like increasing capital from retained earning, instead of distribute these retained earnings to shareholders to avoid the withholding tax on dividends. But this is also, I believe, is a little bit unfair, because actually the money itself did not become at the hands of the shareholders, and it is still in the company. You've just moved it up 2 lines in the financial statement. It comes from retained earning to capital, and I believe this can be true if you want to consider it as dividends. If the capital increase itself from retained earnings would have any effect on the percentage of the shareholders, of the current shareholders, if the current shareholder percentages like changed from before due to this capital increase, I believe this is some shareholders are get benefits, some other reduces their benefit. But if the same shareholder structure, and now you've increased capital from the returned earning to the same shareholders with the same percentage, there is no benefit here to the shareholder. And actually, the money is still in the company. And this is quite aggressive to consider this as dividend distribution. I believe they need to add some clarifications and some constraints on this point in the executive regulations, because leaving this widely open will definitely affect how groups in KSA, how groups of companies, KSA, restructuring their current structure. And especially when there is no change in the ultimate beneficial or ultimate shareholder. Why the company is going to pay dividend taxes? Because there is no money have transferred, and they are not transferred to the shareholders, to other shareholders, or the shareholder percentage change. No, it is the same. So this also one need to be considered.
I totally agree. Yeah. So yeah. For any new coming tax law, there is a lot of issues or a lot of discussion will be going around it. But let's try to move quickly, Mohammed, because we only have a couple of minutes, and we need also to answer some questions that we are receiving. Of course, we will share this slide with all the audience or attendees, and we are happy to connect offline separately if you have any query, going to discuss. As I mentioned in the beginning of the webinar, it's a totally new law. and it contains a lot of provision. And one webinar will not even cover 1% from this discussion, but we try to highlight to you some main important points. As an example, for other consideration for draft income tax law, now in KSA, they are introducing GAR or anti-tax avoidance procedures, like we have in UE introduced recently. Like that, so in summary, Zatka can challenge any transaction or any position you may take or you may have if you don't have a proper backup to justify this from business requirement or business perspective. So they can think that you are doing intentionally to avoid some taxes. This is very powerful provision, gives a very powerful hand on Zatka auditors to challenge whatever transaction maybe you can take. So you need to be very careful about any transaction can impact the tax treatment, and you should have a supporting position or supporting document in place to justify your position. They also now introducing BIPS Pillar 2, which will be officially introducing now based on the proposed income tax law, and we will see in the executive regulation what will be the details of such an introduction of Pillar 2. Merger and merger also they are introducing in the proposed law. Also, they are also covering the capital gain for non-listed companies. So many aspects there. However, maybe Mahmoud, we can give also the audience a very quick background on the proposed tax and zakah procedures law. Please.
So they are proposed new law related to tax procedures in KSA, and I believe this law will be for all taxes and zakat. The law definitely is new, and the application is wide and gathering all the procedures from all the current tax law and zakat law in the KSA and unified it into one law. And if you can see here, the law is divided into 9 chapters. Each chapter could taking an interesting subject and dealing with. I'm not going to read this. It's for the purpose of showing how the law is divided. Now we're going to discuss some of the points in the law. Actually, there is not a lot of changes, but there are some main changes that need to be discussed. Like when you're talking about tax registration, the books and documentation, tax return, how tax is going to be paid, the assessment by the tax authority, penalties, which have a lot of changes that will affect the taxpayer, especially in related to income tax, and tax evasion, which also has one of the huge changes that happened. Now we will be talking about tax registration. They introduced in the new draft law on voluntary registration can be requested, and Zatka can approve this or refuse it, subject to certain conditions that are mentioned in the law. And also they are gathered, if you see the current income tax law and how procedures are existing in the current income tax law, you can find it in one place, like the deregistration in the tax return part, the registration in one part. But right now it's more organized, and if you want to search for something, you would definitely find it in the tax chapter that is related to. Also, as a book says, it's still the same mainly, but now they are asking that the book should be maintained at least for 4 years. That is one big change you have noticed. Rather than this is mainly the same. When you talk about tax return, they are now defined all the returns that should have been submitted by the taxpayer, including real estate tax, including and introducing a new separate return for capital gains is also introduced. And this is one of the biggest changes. Also, they leave the time required for submitting a corporate income tax return to the executive regulation. Before, it was 120 days from the end of the tax year, end of the financial year of the company. But right now, it is left for the executive regulation to determine that. And this is one of the characteristics of
the same. I believe it will be the same, but the interesting point here on the tax filing, they're introducing the new tax return for capital gains, especially because capital gains was one it will be indirectly disclosed was usual tax return or the CAR return, but introducing separate tax return for capital gains, I think there is a lot of transaction or relative adjustment or discussion will be around it. So yeah, please go ahead, Mahmoud. Next slide.
Okay. The next slide is talking about payment, and also it is mainly the same. However, they left the advanced payment system determination and procedures and requirements to the executive regulation rather than what is currently in the current income tax law. And they also stated here that is a joint liability for non-residents for tax not deducted at source. And I don't know why this is like stated in the tax procedure law. It is also stated in the new draft income tax law, but they are stressing on it. And I believe they have seen that there is a potential tax income from service run abroad, and they are now focusing the tax authority in KSA are focusing on payment done from KSA to outside KSA in order to tax that. So they are introducing a lot of provisions to keep these taxation in KSA. So although it's a tax procedure law, but it's one definitely new change that they are stating on the joint liability for non-residents for taxes were not withheld from KSA side. Also, buyer and seller are jointly liable for capital gain, especially when dealing with companies that is resident in KSA. And this is one interesting point because this, I believe, will create a lot of issues with the dealing with the tax authority, because buyer, when he buys a company, he did not make a transaction that should be subject to tax according to the new draft law. So if you're buying something, how this is going to how the company is going, if a company buys shares in KSA company and this company bought the shares, there is no income done by this company who bought the shares. There is no taxable income actually. And asking the buyer to be jointly liable for a transaction for an income that he did not gained, it is what is quite aggressive, and this will create, and this will need to be watched for when you are approaching to getting investment in KSA, especially when you're buying shares from a KSA company. That should be clauses in the SPA defining that the seller who's going to pay the capital gain tax, and there should be also warranties that defend that lower the risk for the buyer because of this clause, because this is actually quite aggressive, and I have not seen like if you bought something and you're now paying income tax for the gain you have not received. This is actually quite aggressive, and SPAs need to be reviewed carefully when you're dealing with companies when you're buying companies in KSA. Also, when you're going to approach a target in KSA, the tax due diligence should include, when you're approaching your tax advisor for a tax due diligence on a company you target in KSA, should include determination of the income, the capital gain tax that is going to be a result of this transaction. And there should be clauses here that protects the buyer if the seller failed to pay these capital gain taxes. And it can be done in escrow agreement. It can be withheld from the selling price. There are a lot of ways, but this going definitely affect the investment in KSA, especially when you're approaching to buy a company there.
Yeah, thanks, Mahmoud. Can we quickly go through on the other
Yeah, I'm
slide
going to.
because we already passed the time and
One
we
of
received a lot of
the
questions, please.
one of the biggest changes here that the statute of limitation, as a normal statute of limitation, is reduced to 3 years. However, the statute of limitation of real estate taxes, it's the tax authority, when introducing this law, it's extended indefinitely until the tax authority knows of the transaction of the real estate taxation. And once the tax authority knows that the statute of limitation is 3 years from that date. But if the tax authority did not discover, the statute of limitation is going on. If the company fails, of course, to submit a tax return, but if the company submitted a tax return, that means that can knows of the transaction, and it starts 3 years from this submitting the tax return.
But if they didn't submit it would be 10 years as the current income tax law. Yeah.
Penalties, now they changed the regime of penalties, the provision of penalties. It is now 2% monthly, up to a cap of 24%. From about if the company fails to submit the tax return in the legal due date, and it is monthly from the legal due date until the date of submitting the tax return and paying the tax. But it's kept at 24%. Also 1% interest on if the ZCA has done an assessment on the company's tax return and there is a difference. They added 1% penalty on such difference if the company fails to pay the assessment amount in 30 days from knowing that from the assessment notification by ZCA. Evasion, it is mainly the same, but they introduced a new one here: importing of processing of goods to be sold in KSA without submitting the tax on such goods and services is now required, considered as a tax evasion. And it is interesting. We want to know how they are going to apply this and how the executive regulation is going to deal with this new point. Also, the penalty for evasion, it was 25%. Now it is 100% of the difference, and it can reach 300% of the difference. And that is very huge. And again, yeah, the tax authority has its right to protect the national income from evasion cases and whatsoever, but increasing it from like 6 or 4 to 12 times, that's a huge change need to be observed. I believe this is a quick review for the tax procedure law, and now we are open for some question and answers. And there are some questions here on the panel. And Hani, can you please handle this with our audience?
Yeah, thank you, Mahmoud. So now, in summary, again, the new proposed income tax law in KSA, along with the proposed tax and zakah procedures law, it's totally a change on the tax regime in KSA. It's not an amendment for some provision or articles from the current one, which we have in KSA, but it's a totally and dramatic change. As we highlighted on the beginning also of the session, that it's for public consultation. It should be ended or closed for all consultation by December. Our expectation, it can be released by January. So it can cover January 2024, starting from January 2024. From our experience with the KSA market and ZCA, I'm all for the proposed laws or the changes. It always coming with the same what already released for public consultation, maybe some slightly or small differences. But we have a reality now. There is a new income tax law will coming. Our general advice to any taxpayer for any transaction we are getting into, starting from January 24, or you already have one from now and will be extended or will continue for next year, just have a look, overall look on the proposed laws and see if there is any big impact or you or not, and how you can mitigate this impact. We are not saying or advising to change or cancel or doing anything can harm your business or activity, because we are not working in general on to satisfy the local regulation rather than to focus on our business or activity for each country. But at least you need to understand what is coming as a big change. We will share this slide with you. And again, it's not covering the full provision or all the changes, but at least we try to highlight the main aspect. But happy also to connect with us and discuss anything you have in your mind, come in your mind. You can drop us an email or drop a message or call us anytime to discuss. We already received many questions, and due the time already passed, we will answer them by one for each person who sent it to us. We will type our answer, he will receive it. Quickly, I will try to cover as much as I can, but quickly. Thank you for the session so far. So as what I understand, the salary or bonus income of expats will not be taxable, correct? Yes, as far as now, there is no taxability for such income. I hope they will not change or hear your message or hear your question and try to introduce something extra. Another question, if a consultant who is based in France branch office is performing service for KSA branch office and was in KSA for more than 30 days, then will be France branch office create a BE in KSA? Yeah, it's a question include 4 aspects, BE and the service and the payment and a branch. So are you asking, we will send you our answer, but the answer should be on a question also. You have a branch for France office in KSA, same activity, everything, and you are supporting them only, or you are providing this service for another third party or whatever, another client in KSA market directly to him? Because answering this question will have a very different answer from BA perspective and for withholding tax and for residency concept. So you need to, if you are dealing directly with a customer in KSA, yes, our answer will be yes, you will have a BE there, a BE risk if you are exceeding the new proposed time for 30 days. But if you are providing such a service to your branch office in KSA and you are charging them for such a service only, then there is no BE here, but you need to also consider about the withholding tax. We have also many other questions. Allow us to please to send our response, because I know many of attendees already arrange their timing by 12 maximum to finish this webinar. So again, it's our pleasure to have this webinar with you all, and we are expecting a lot of changes coming in KSA market to adapt a new tax worldwide regime and the new business in KSA. Also, my personal advice to you, read also about special economic zone, which is Saudi now in discussion to introduce in KSA, which will have a huge tax incentive and customs incentive also in Saudi market. If you are considering to get enter in Saudi market, have a look on this one also, and happy to connect and discuss again. Thank you, Mahmoud, also for your view and your comment on some of the aspect of the law. Thank you all, and have a very wonderful, lovely day ahead. Thank you all. Bye-bye.
Thank you. Thank you all. It's a pleasure.